Hey there, everyone. Welcome to Chart This with Dave Keller. Happy Friday evening. I'm Dave Keller with Market Misbehavior. Thanks for joining me here from not a rainy Redmond, Washington, but a beautifully sunny San Francisco, California. We're in town for the CMT West Coast Summit here, so apologies for the late kickoff. This is the best I could do working around the schedule going on this afternoon here at the CMT event. We're doing an all-day conference tomorrow. Boy, perfect or maybe imperfect time to do a conference. Getting a bunch of technical analysts together, sort of lamenting about how the charts have evolved in the last 48 hours, I'm sure will be a main topic of discussion. But already just meeting up with some people that I've it's been a pleasure to reconnect with. Just talking about market conditions and how quickly they have rotated in a somewhat aggressive fashion. Friday is usually our mailbag day. I am going to take a couple questions that we got during the week, but given the degree of the magnitude of the drop today, thought it might be better spent just going through some of the charts, maybe trying to put some things in a proper context, give you some initial takes on downside targets because I did not get a chance to do a separate YouTube video to focus on that. So I'll give you some initial takes on that, and then I'll be following up with my Market Misbehavior Premium members with our weekly flight plan and a lot more detail about positioning and expectations going into next week. But wherever you're at, I appreciate you tuning in if you're doing it live. Again, apologies for the late kickoff, but thanks for hanging with me as we do it here. Let's get to the markets and see how things played out. I am sure by the fact that you are following me and following my work, you are probably following the markets fairly closely, and you probably know what I'm going to tell you about the markets, but they were down aggressively today. And I will tell you, what was different from Thursday to Friday. And I would say it's the change in participation. Yesterday on Thursday, which is sort of that first post-tariff drop, a number of things were actually up. And actually that was main point of that we made yesterday was just look at all these things that are actually going up. And plenty of things certainly were. Today, very few things to find that were going up. They're out there, right? I mean, home builders finished in the green. The VIX, although I know that doesn't help many of us. If you own VIX futures, you probably had a pretty decent day with the VIX pushing over 45 today. But we had bonds actually finished higher. Bitcoin, look at Bitcoin turning into a safe haven out of nowhere, not falling victim to the aggressive downside move in most other risk assets. Bitcoin kind of bucking the trend, as it were, and managing to hold steady. The GBTC, the Bitcoin ETFs, were up a couple percent today. So there were things that were out there, but very, very few. Yesterday, it was very easy to find things that were still holding up. This was kind of an everything drop. And I think that tells you a lot about the change from just an initial uh-oh to more of a full panic, which is what you're seeing here. We see the markets moving down to the percentages we're going to show you, the VIX moving up to the degree that we've seen. These are rare occurrences. Thankfully, do not happen often over the course of your career, but they are happening this week, unfortunately for all of us. All right, with that as an intro, S&P down 6% today. We're below the 5,100 level we talked about just yesterday. How quickly that level has come and passed. We're now around 50.74 at the close. The Nasdaq actually slightly outperformed the S&P. The Nasdaq Composite down 5.8%. Mid caps, small caps down, but the S&P 600 small cap index down the least, down only 4.2%. Nasdaq 100, the mega cap names, down over 6%. And as I mentioned, the VIX, accelerating to the upside. So, we've talked a lot about warning signs going into this week for sure. I mean, we've been covering them closely, tracking this downside rotation, this rotation to more defensive positioning, and doing it back when we were talking about it before is why days like this feel, this days like this are why you make those changes earlier. That's why we follow our medium-term market trend model when it turns negative. It's just to avoid sitting there and watching a day like this destroy your portfolio in a painful way. The VIX now well above any sort of threshold I've ever seen, separating a low volatility from a very high volatility environment. I think we're past the high volatility into more of a panic range. We're now in a very low number of observations in the history of the VIX, and the VIX getting up to these levels. And it's usually in a pretty bearish year. Given everything we've learned, giving all the conversation, giving the lack of upside participation I'm seeing, certainly feels like a 2022 type of environment for the foreseeable future. That's kind of how I'm generally tracking what we're seeing here. Let's look elsewhere. Fair point. TLT did end up higher, although it didn't just trend higher through the course of the day. If you look at what happened, and we'll look at the bar chart in a moment, I did grab that chart to focus on. You can see that the TLT actually opened higher, actually traded lower through the course of the day. So the TLT actually finished at the lows. Now it was still up 1.1% from Thursday's close. So anything up at all today is pretty big news. The dollar up 1%. That's meaningful because most things were down. And the stock to bond ratio, which we shared yesterday, very much favoring bonds, not even close at this point. So rates coming down as bonds are moving higher. And again, that seems to be the general trend that we've been observing and that we will continue to observe. Stronger bond prices, weaker interest rates, and that's really fueled by lower expectations, right? Expectations of no economic growth or weaker economic conditions as a result. Rates coming down, yield curve becoming more inverted. In the end, this ends up usually being a pretty good thing because eventually rates are lower and it's easier to borrow money and easier to buy a house, as the example of home builders that I mentioned earlier, one of the few groups actually in the green, but certainly speaks to a lack of optimism about economic conditions, certainly given the tariffs. That's the big change that we've seen here in the last couple of days. Looking at the commodity space, again, it talks about changes from Wednesday, Thursday into Friday. Commodities down big. So gold down 2.3%. Granted, still a pretty decent chart, but not up today. Silver down over 6%. Copper prices 8.5% lower. Crude oil prices down 6%. So this is the market pricing in weaker global economic growth, an escalation of a trade war, tariffs being reciprocated, and again, just uncharted territory, pun very much intended, in terms of what the ripple effects of all of these changes are going to be. Professional investors have not seen this particular combination of circumstances before. You're not alone. And so people I know that I'm talking to were all just sort of trying to, again, make educated guesses based on previous panics, previous dislocations. But this specific set of circumstances is incredibly rare. And the last time you had this sort of change to a very sort of, almost isolationist American foreign policy, particularly on the economic side, you're going back 100 plus years. The market structure was so completely different. I don't know if looking at like an analog from the early 20th century really holds a lot, relative to what we're seeing now, because the structures are different. Just the fact that we're in such a global economy now that this is changing. And again, for me, it's a great reminder to go back to the fundamentals of technical analysis, go back to the charts. The charts will tell you where expectations are changing. The charts are telling me people are not optimistic. People are taking bets off the table aggressively. The charts are telling me to avoid risk assets until further notice. Cryptocurrencies holding in there today, and this is one of the most interesting things. If you told me that stocks would be down 5+%, most equities were down 90+% down days on most of the major equity indexes. I don't know if I would have Bitcoin up a bit on my bingo card. I would probably have Bitcoin down aggressively in this environment. Very interesting to see that that's not the case today. And I think that's something that we'll be unpacking. Certainly, I haven't seen a lot of non-technical commentaries speculating as to what is holding Bitcoin up to the degree that we're seeing, but certainly something to certainly something to observe. I mean, again, anything that's not down in this environment is worth just paying attention to and just trying to understand what is causing this difference in behavior. So bonds up, cryptocurrencies up generally, very important to note, in my opinion. All right, we'll look at the sectors. As you could probably guess, none of the sectors higher, and very interesting to see both of the consumer sectors down a bit. So again, this is a very different look than what we've seen up until today. And the last time I've seen this sort of acceleration, maybe in the COVID crash for sure, but for me, this feels a lot more like the financial crisis. This is, mid 2008, late 2008 kind of days where everything's in the red. And I remember sitting in my office at Fidelity with a couple other, couple of my analysts, just no one saying anything, just kind of staring at the monitor, just thinking, just trying to think about what do we do in this particular environment. This is a new one. The good news, as you'll see from one of the charts I'm going to show you, it'll get better. That's one thing I can pretty much assure you. I don't know how quickly, and I don't know what the path is going to look like, but the market has recovered from pretty much everything in history. So I think it'll get through this as well, but it could be a painful experience for sure. So what's different here is we've talked a lot about offense versus defense, right? Offensive areas of the market struggling, defensive areas of the market doing well. Even yesterday, you had defensive areas of the market actually up on the day. Not today. And the two top performing sectors were the two consumer sectors, and they were down almost an exact amount and both down over 4%. So this is less institutions rotating. This is more getting out of risk assets and just trying to get out and find find safe havens outside of the equity space. Anyone that's able to do that is probably doing so in this particular environment. So the top performing sectors, but again, not great. The two consumer sectors in real estate, both down around 4.25 to 4.5%. Energy, the worst performer, and it certainly looks like one of the early losers in a post-tariff world is the energy space, for a number of reasons. The XLE down big yesterday, down again 9% today. Financials number two, down 7.3%. Technology number three, down 6.6%. So again, this is a broad decline with pretty much every sector feeling the pain. We're going to debrief on our market trend model over the weekend and update our premium members at Market Misbehavior. The quick answer, though, is long-term model still bullish, but for me, the medium-term model is the main one that I follow. So it turning bearish about a month ago, feeling pretty good about that warning sign, because it's designed to help avoid periods like this where everything's sort of going down. Great reminder, though, again, on the front page of stock charts, there were a handful of names that were actually up. And if you look at what was up today, Lululemon up 3%, and then a bunch of home builder kind of things, Decker's Outdoors, and then it's a bunch of, DR Horton, NVR, Pulte, Lennar, some of these like Nike, Target, these were names that were down a ton in the initial reaction to tariffs, but then actually recovering a little bit. And those might be some interesting names to look at as well. Names that did not follow through on the down move today. But as you can see from the breadth, most things were down, right? On the S&P, 97% of the S&P members were in the red today. So this is sort of an everything down kind of day. The Magnificent Seven, just briefly will update. Again, the best performers were still down about 3.5%. Alphabet and Microsoft. On the downside, Tesla down over 10%, Nvidia, Apple, two of the biggest weights in the XLK, down over 7% today. The market carpet, I feel like I don't really need to show it to you, but it is bright red. And again, there are a very small number of names that were not down today. Those are always important areas to look at. Things that were not participating in the downside today. Home Depot and Lowe's actually flat today. Kind of interesting. And again, it's home builders and home related things that appear to be the biggest, the only things going in there. But the good news for those names is interest rates are coming down. If you are looking to buy a house, it most likely becomes more affordable in this environment, would be my guess. I mean, looking for silver linings here in this environment, but generally this is a broad day where you don't want to be owning equities if at all possible. So with that as the backdrop, I want to just look at some charts. I will take a couple questions, and I did hand select some questions that I thought were kind of appropriate for this kind of day, more big picture questions that I've gotten, talking about broader patterns, talking about some of the warning signals that we've been looking at that I think would be appropriate to go through with you. But otherwise, I just like to try to put what we learned this week, and particularly today, into proper context. So this is how quickly, when I've mentioned in recent weeks and recent months, a waterfall decline, right? We talked a lot about these are the warning signs that often come before a waterfall decline. This is what we're talking about. This is just so we're aware, like this is the kind of thing. And this is why it's called a waterfall decline, because all of a sudden everything's going off the cliff and rolling over very quickly. Price targets are almost laughable in this environment, to be honest with you, because it's moving so quickly and moving so aggressively. In my opinion, it's less about pinpointing a target, because if the S&P hits 5,100 today, I'm not a buyer just because of that. Like in this environment, I am completely waiting until I see some signs of accumulation, some signs of optimism. I am 100% happy missing the actual bottom for confirmation that there are bottoming forces at work, meaning someone before me is coming in and willing to take a shot on these stocks. If you want to try to be the early ones getting in early, buying the falling knife, I wish you good luck for sure. I would just say make sure you have good money management strategies because there's no reason why this can't go down even more on Monday and after that. So again, it's less for me. It's less about targets and it's more about trend. It's more about momentum. It's more about recognizing opportunities that we could have some sort of a reversal. So our 5100 target that we talked about reached today. We sort of reminded everyone about that yesterday on the gap lower post tariff. We're now there. So I mean, again, when you have an acceleration like this, usually very early you'll have an initial bounce, right? Because it can't just go down forever. Because what happens is at some point, even with how bad tariffs could be, even with how much this could destroy the global economic forces that we've been tracking for so long, even if the disaster scenario plays out, the equity markets are a forward looking mechanism. We're pricing forward. At some point, things get so cheap so quickly that it all of a sudden seems like, look, at some point things are going to get better. We're going to get through this, and at some point these look like pretty decent bargains. I mean, the S&P is down from 6150 to 5150 in about a 6-week, 8-week period, and so I mean, at some point things look cheap enough that we're just happy getting in and riding a little more down period, but just for the opportunity to play on this recovery. So at some point we start to get these counter trend bounces. Arguably, that's what some of this was. It was sort of a counter trend bounce after that initial sell off. Now we're getting another big leg down. What's interesting is if you measure I'll show you the measurement I think on the next chart. If you use the bear flag pattern, we're kind of there at the minimum downside objective, if not a little bit further today. So we have to update our downside targets. For now, I would say the good thing is there's a weekend now between today's close and Monday's open. We'll see what sort of additional news flow maybe comes out over the weekend. We'll see what happens at Monday's open. And if buyers start to come in on force and cause a bit of a bounce here, I would not be surprised if that happens as we test the August 2024 low, and again in a way that was not expected to happen so quickly, but is now happening. We'll see, and we'll see if there's some sort of bounce, and maybe that validates this 5100 level for now. I wouldn't be surprised if that's broken, just given the severity of the sell-off that we observed today, and I'll update that in a chart or two. This chart, I'm doing a presentation tomorrow for the CMT Association. I'm going to include a chart like this, and I often overlay the logos of the firms I've worked for on this chart. And it's meant to, just sort of visually give my bio, like what have I done over the years and my experiences in the market. But it's really more just to remind people that uptrends and downtrends happen, right? And the longer you're an investor, the longer you're in the industry or just investing in your own portfolio, the more you've seen crazy declines like this. And while I will not tell you I'm particularly happy with how things are playing out, I don't find joy in the market going lower. What's good is they have been fantastic learning experiences. And when I look back on this chart at these major pullbacks, I first learned about technical analysis in 2000 to 2002. I learned it in a cyclical bear market during a secular bear market. And I will tell you around 9/11, I mean, it did not feel like recovery was not something we were talking about. I felt like this was going to get a lot worse. I mean, the questions were, are equities ever going to recover kind of questions? And they did. And then the global financial crisis we recovered from COVID. We recovered from, a lot of other things, even off the left side of this chart that I was not investing during. However this plays out, we will recover from it. So I would tell you, this is not a time to panic. This is not a time to start aggressively dumping things necessarily. This is a time to certainly think about context, to zoom out, to reflect on what your runway is. Think about your investment horizon on a portfolio that you're working with, whether it's your own portfolio or your clients' portfolios, and just make sure you have that proper perspective, right? Because if there's one thing I've learned is every correction provides some fantastic buying opportunity. Pinpointing that buying opportunity cannot be easy, but it's going to be there. And so this is the time to be following the charts quickly if we can. And sorry, I'm in an unusual setup here, just setting up a little earlier on the in a hotel room. So I hope everything, it looks like things are coming through okay. And I appreciate you guys tuning in live. Those of you that are. All right. So, an initial take on some downside objectives. And again, I'm going to spend some more time on this and share that with my premium members with our weekly flight plan. But as an initial take, again, for me, price targets are not the most important thing in the world. In this environment, it feels like they are, and I understand why. We're all trying to identify some level. There's a lot of guesswork in any level, I will tell you, having done this a number of times. I don't mind doing it because I think it's helpful to at least have some sort of framework with which you can then adjust and adapt. But again, I would not build a portfolio on whether we hit a certain level, and that for me, it's more about trend. And for now, the trend is definitely down. So I will get excited about buying stocks when the trend is not so obviously down. It's obviously down today, so I'm happy avoiding things. So if 5100 would not hold, and it's just a little busy chart, so apologies, but what I'm doing here is looking at two different time frames. The main time frame with these pink Fibonacci retracements is the 2022 low to the February 25 high. Using that low and that high, 38.2%. It was around 5130. That was our downside target. That's where we came up with it, among some other things. Also lines up with the August low from last year. We're there. And again, we've closed below it today. I think we need to see what happens on Monday to validate whether that level is technically going to hold, but it certainly looks like this is going to be broken. Here's that bear flag pattern, by the way, that we talked about, and the minimum objective was 5,200. We've clearly blown right through that one. So if at the beginning of next week, it's clear that that's not going to hold, the next range for me is kind of a wider range. I'm going between 4,750 and 4,900 because there are a number of different levels all kind of in this place. There's the 50% retracement of that same time frame that we talked about. That's around 48.18, 48.20. 48.80 would be a 61.8% retracement of the October 23 low to the February 25 high, kind of a secondary area to look at for me, which is why I didn't quote it much earlier, but that's technically around 48.80. The 150 week moving average, and I'm just showing the daily chart here, but I'm sort of overlaying where the 150 week kind of is. It's right around 47.50 right now. So I wouldn't be surprised if that ends up being around the eventual low. So I'm kind of thinking of that's the next level. Again, if we further deteriorate, that would be the next level I would look at. The ultimate level could be around 4,500, and that's based on a 61.8% retracement of this overall, move from the October 22 low to the February 25 high. 4,500 would be a 61.8% retracement. If we see further acceleration next week, I think that's probably that would eventually be a good area to consider. But again, for me, price targets are secondary, trend is primary. I want to focus on the trend. For now, as you can probably guess, trend is down, I'm out, or in cash and defensive, which is where I'm at. Breadth conditions all taking a bath today and aggressively going to the downside. Here's one of the breadth indicators we've quoted quite often. I don't have time to go through all of them, but we're down to around 23% of the S&P above their 200-day. So let's keep that in mind. About a quarter of the S&P are still above their 200-day. So a lot of names that were down today are still above a 200-day moving average. I think a simple screen for stocks above their 200-day, those are probably decent places to be if you have to be in equities, or if you have most people have some exposure to equities at some point. I still do. I still have probably 25% of the portfolio, 20%. I don't know off the top of my head, still in equities of some sort, but it's in equities that are stronger than Nvidia, right? I mean, they're ones that are holding up. One's showing strong relative strength, so I don't mind having some exposure, but it's in the areas that are doing well. So a quarter of the S&P are still above their 200-day. That's an interesting place to look. Only 13% of the S&P above their 50-day moving average. Now, what happens is when these get so low, they often end up being kind of a contrarian buy signal. We're kind of down around that point for this particular indicator, which means at some point we probably get a pretty quick snapback rally, what we call a dead cat bounce. As we saw back here, bear market rallies are sudden, swift, and seductive. For me, I'm going to be patiently not getting sucked in as much as possible to a quick bounce. I think you wait for more of a rotation, but we'll see how the charts actually play out. All right, looking at some other charts here, and then we'll take a couple questions and be done. Bond prices moving higher today, although it's worth noting they did trade lower through the course of the day, similar to yesterday. So both yesterday and today, the TLT opened higher ended up closing below the open, but still ended up being positive for the day. The momentum is still good. I think the general trend in bond prices are higher. I think this is a sort of a bull flag pattern of sorts, not as idealized as you see on the chart of the S&P 500, but I think breaking above this pink trend line is pretty important. So bond prices trending higher at this point. That means the stock to bond ratio, which we talked about breaking down through the 200-day, turns out that was just the beginning through the end of this week. Clearly, this ratio is going lower. So being in fixed income assets over equity is pretty good. Bitcoin actually up today. I mean, the chart of Bitcoin is technically flat. The chart of the GBTC, which is one of the Bitcoin ETFs, is kind of flat here over the last 6 weeks, but flat over the last 6 weeks is pretty awesome, especially after the last 2 trading sessions. So, look for charts like this that are holding an ascending 200-day moving average. I don't have a problem, a portfolio filled with things like this. Whether or not you think things are going to get a lot worse as they break the 200-day, get rid of them. But for now, things are holding up okay. So there are things out there, and that's just what I've learned in any of these corrective periods. Something somewhere is probably working. Use charts, use scans to do it. If you do have to be in equities, and again, I tend to have a position in equities, even in the worst markets, just to have at least some exposure there, because I think being completely out of it is usually not a great idea. So for me, the things I'm in are these sorts of sectors, defensive sectors. Here's the relative strength in the 4 defensive sectors. We've been rotating this chart in pretty often recently. You can see the relative strength is good. Now, it doesn't mean these sectors aren't down today. All 4 of these were down today on an absolute basis, but down less than the benchmark over time usually means you're going to ride this period out and have a much better experience than if you're in a passive product like the S&P. So if you do have that equity exposure, for me, I'm looking at areas in the market demonstrating strong relative strength, holding above levels while others are unable to do so. All right, I have a couple questions that I grabbed from earlier in the week. If you have questions that came up, pop them in here. I'll save all of those and probably get to them early next week as we can. It's just hard to get your head around some of these moves, which is where we're at. All right, let's get to a question. 3 questions I grabbed. Number 1, how valid is the ratio of XLY to XLP now, since Tesla and Amazon are over 35% of the XLY? It is a really thoughtful question. I just wanted to share that with all of you. What you have to remember when we're talking about sector movements, and when I'm sharing with you this, what you have to remember, these sector ETFs are many of them very top heavy, right? So the XLY 3 stocks make up about 50% of them. The XLK 3 stocks make up about 50%. Nvidia, Apple, Microsoft. The XLY, it's Amazon, Tesla, Home Depot, about 50%. Most of these have a top heavy communication services. It's the big internet names, Meta and Alphabet. So a lot of them have that issue. So when you're looking at the percentage returns, you have to remember they're exaggerated in terms of how much they are reflecting the movement in those biggest names. It also speaks to the strength or weakness of the other names in there. They're part of it, but just such a small part of it, right? And so there's the reason why I think your question is valuable is 2 things. Number 1, hopefully some of you have listened to my latest interview on the Market Misbehavior podcast with Michael Green of Simplify Asset Management. We talked about concentrated benchmarks. We talked about flows and how much passive products have exaggerated this top-heavy scenario, what it means for market analysis and valuations and so many other things. So please go listen to that interview. Super smart guy and really well documented in terms of the effects of passive investing. I thought were really, really interesting, specifically the exaggerated benchmark issue that you're alluding to. The other thing I would tell you is, as much as possible, what I try to do then is consider cap-weighted and equal-weighted versions of these ratios. So this is the chart I often use to show offense versus defense. XLY to XLP is the top series. So that's the normal kind of cap-weighted, most liquid ETFs. But the bottom panel is the equal-weighted consumer discretionary versus equal-weighted consumer staples. All right, so we're looking at the equal-weighted version as well. Sometimes these actually have differing messages. So for example, there are times when you'll see the equal-weighted version like rallying more. For example, here in early 2024, when the cap-weighted version is actually trending a little bit lower. The cap weighted version actually peaked in mid-January before rotating lower, while the equated version actually continued on into the February peak. So there are times when they will have a somewhat different message. This is one of those times where actually they're both trending downwards over the last 6 weeks or so off that February peak. Both of them have been trending downwards more aggressively. But if you ask me which is more important, the equal-weighted version is more valuable to me because I want to really think about the rotation that investors are making between some of those names, and the equal-weighted version is a better reflection of that. But given how many assets are going into the cap weighted ETFs, I think looking at both is actually pretty helpful. And that's why I try to show both of them together as much as I can. But that's why I have two different series looking at offense versus defense for that particular reason. Next question, the XLV making a head and shoulders pattern on the daily chart after getting multiple rejections from the 200-day moving average. Would you agree? And the short answer is I absolutely would. Let's look at the chart here. So, let's look at a regular chart. So it's so funny about your question, by the way, and I appreciate you watching and sending that one in earlier in the week. When I initially brought up the XLV, I assumed you were talking about this big head and shoulders pattern, but I actually think you might be talking about this shorter one because this is where we're actually testing the 200-day moving average. But so what's interesting is actually multiple head and shoulders patterns on this chart. Let's start with this shorter term one, and then we'll zoom out a little bit. So start a little more short term, and then we'll come out. So this is the sort of short term head and shoulders pattern, which really wasn't broken until today, right? The way that you draw a pattern like this is it's not a valid head and shoulders pattern until you break the neckline, which is where you connect the interim lows, the swing lows, right? So you have a head, a left shoulder, a right shoulder. You have the swing lows in mid-February and mid-March. We tested it. Finally, today is when we're finally breaking that pattern. So as of today, valid head and shoulders topping pattern confirmed. The problem is that the minimum downside objective is basically today's low. It's, if you take the height of this pattern, subtract it from the breakdown, it kind of gives you an objective down here right at the December low. So we're sort of there. So that's where you might expect at least some short-term support on the XLV. Again, one of the, things like this popping up make me think the beginning of next week, maybe we get a bit of a counter trend bounce. But that other broader head and shoulders pattern, maybe on the weekly chart might be a little easier to see. It's sort of this pattern here, right? The head, the left shoulder, the right shoulder. I'm doing a weekly chart. So this is the 40-week moving average. This is the 150-week moving average. So, again, we can't call this a confirmed head and shoulders pattern until and unless we break down through the neckline, which we actually technically have not broken down through yet, right? So there's the low from April of last year. Here's the low from December. You can see it's literally right around the 150-week moving average, right below today's low. So, again, the challenge is things like this have sold off so quickly. We're getting quickly to like a 150-week moving average, which often has served as support. That's why I have it on my weekly charts, just because when things get down to that level, that's when we really have to reassess whether this is a protracted bear market or where a lot of cyclical bear markets kind of stall out there before you reverse higher. So I think expecting some support here makes sense at the neckline, but if we break the neckline on the weekly chart, boy, that is an ugly breakdown. And again, this is not the only one. The XLV is not the only chart that kind of has that a similar kind of read to what I'm seeing here. That's why you have to remember that things, while it feels like things have gotten very bad very quickly, we're still not down that much. I mean, as crazy as that sounds, right? I mean, if you look at the daily chart of the S&P, just from the intraday high in February, I mean, we're down a good amount, right? We're down 18%, 17%. That's nothing when you look at some historical bear markets, right? 50+% is certainly possible. So again, I'm not saying we're definitely going to get there, but I'm saying I'm concerned by some of the patterns like the XLV, looking at like we're at a very clear breakdown point, kind of a point of no return, where if we break down below those levels, I think you have to assume we're in sort of a 2022 protracted decline. It's going to take a while to sort of work through these issues kind of market. All right, last question, and then we will call it a weekend. And I hope you were able to find joy and peace regardless of what your portfolio has done today. Is it possible to be successful by just trading the charts with PPI, CPI, elections, earnings, and so much more? The distractions are endless. Looking to simplify. I actually got that question a couple weeks ago. I've been saving it for an opportune time. Seemed like a perfect day to bring this up. And it's so funny in an environment like this, to digress for a moment. I get people saying, like, do charts even matter because this is just about tariffs? Do charts matter because it's based on a military action or geopolitical issue or some big earnings announcement or whatever it is? I mean, as you can probably guess by the fact that I've made a career out of looking at charts, charts always matter. The how they matter and how you use them and how they're valuable in your process can change based on the market conditions, right? But I would say charts are an incredibly valuable way of just understanding what's happening. This market is reacting to a severe emotional reaction, right? Panic selling. I mean, I don't know how you would describe today. It certainly felt like panic selling to me in a lot of ways. It's changing expectations, dramatically changing expectations as we try to get our heads around, potential ripple effects of changes that have been made at a high level policy here in the U.S. and what that means, and a potential trade war and how that could play out, and how do you price, how do you value companies when there's this huge unknown. I mean, buckle up for earnings season happening in a couple weeks here, when we're going to have companies trying to explain how this is going to affect their business. I can't see how that's going to be a real bullish experience, to have a bunch of companies telling us how they have to spend a ton of money and reconfigure their whole logistical thing. Again, barring some huge, unless all of this is unwound next week, which I don't think happens. I think it's going to be a lot of companies telling us some rough news about how this hits their bottom line and their top line in a lot of ways. So I get all of that, but I would say that what's important is that analyzing the charts helps you understand that fear, that greed, how the expectations are changing. The charts will tell you when people are not panicking anymore. The charts will tell you when the smart money is starting to accumulate because valuations are so low. The charts will tell you when people are actually seeing that there's a long-term runway and it's worth taking a shot now, because the charts will start to demonstrate that change of character. We've seen a change of character from a bullish 2024 to a somewhat bearish, if not very bearish, early 2025. Charts are going to tell you when that downtrend is over. So does it make sense to ignore things like inflation and elections and earnings? No. And I would tell you that, and I guess my way of answering your questions, there are four pillars for investors as I see it. It's fundamental, technical, macroeconomic, and behavioral, and each of them one by one. The fundamental: what are these companies doing? Their ability to grow earnings, or new products, new services, their ability to grow businesses over years, over time, that create value for the equity markets. The technical: how are we actually tracking investor psychology, investor sentiment when investors are nervous, excited, euphoric, desperate, despondent? All charts reflect all of those things in the form of price action and momentum and breadth and all of that. It's macroeconomic, right? Understanding inflation and how changing expectations in inflation, or Fed taking certain actions, that has ripple effects down the road. And so, if you want to understand how expectations may change, you really need to understand some of those macro themes and how they might be, what themes may be important years down the road. And then the last one, which I would argue is really important right about now, is behavioral: getting out of your own way, actually doing what the charts are telling you, selling you well before today when the charts told you they're not looking good anymore, unwinding risky positions when the chart tells you it's not a time to be taking on risky positions. I'm sure many of you, if not some of you, hopefully not many of you, are holding on to something you probably should have sold before today. You probably can think in your portfolio what that position is, and I don't blame you. It's hard to actually do what the chart is telling you to do, but that's the behavioral piece: is actually having a disciplined process, being able to keep your emotions in check, having an evidence-driven process as opposed to an emotion-driven process. So it is possible to be successful trading charts and not looking at anything else. I've known people that have done that. I've known people that trade charts and tickers just like data, and they're just trading a model. For me, though, there's four pillars, and the technical pillar is one of them. But those other three pillars are also important. Not things we talk about necessarily as much on this show, but I would say a well-rounded investor understands all four of those, and having good self-awareness on those pieces, I think, is so vital. Folks, listen, I really appreciate you joining me here on the show. Apologies for the late kickoff. Thanks so much to those of you that are joining me live, unexpectedly so. I'm going to do better at trying to communicate when I'm going to do the show later. I completely the times were not what I expected when I got here to San Francisco. I wanted to make sure I went to the first part of the event. So glad to share some charts with you. Hopefully, if this is something you want to follow more, if you need help navigating these markets, I'm sure some of you feel like you do. Check out our Market Misbehavior Premium memberships. This is a time when I love holding hands with my premium members and helping them navigate these periods. Go to marketmisbehavior.com/premium for more info on those. But no matter what you do, I hope you can find joy and peace and relaxation this weekend, regardless of what happened in your portfolio. And remember, it's always a good time to own good charts. Have a good one, folks.